All right, we did hear what he had to say, but for the moment we leave it at that because we are shifting our focus now to big news that we're tracking as far as the CPI data is concerned. Let me quickly put those numbers into perspective. August CPI is at 2.07%. The August CPI inflation is at 2.07% versus the 1.55% month on month. In fact, the August food inflation is at minus 1.74% versus the 1.76% month on month. In fact, some of the details on your screens are essentially as to how that's panned out year on year as well. But I'm given to understand to be talking to us more on this. Aditi Nayar, Chief Economist, ICRA, joins us on the show, as well as Sakshi Gupta, Principal Economist, HDFC Bank. Thank you very much for taking the time out and joining us here. Aditi, let me begin with you. Given what the numbers that we're just currently looking at, what's the first take that you make of it?
Thank you so much. Well, the headline number has come in line with our expectations. We had expected that as the base effect unwinds, we will get a bump up in the CPI inflation, and it's going to cross 2%, and our forecast was 2.1%, and that's roughly where the number for August has ended. I haven't had a chance to look at the disaggregated numbers, but overall headline looks very much in line with what we had forecast.
All right. While we essentially read into that in terms of being in line with expectations, Sakshi, thank you also very much for joining us. Of course, we'll decode this further, but just looking at the essential numbers that have come in, how are you looking at the same?
Yeah, thank you for having me on the show. Look, I think 2.1% inflation is, as Aditi said, broadly in line with street estimates and consensus expectation. I think this data kind of continues to tell us, this is a very low inflation, print at the end of the day, and it continues to kind of indicate that the fact that inflation momentum in India is remaining very, very comfortable. Particularly for the month of August, I think there has been some increase in vegetable prices, particularly tomatoes, that we have seen, from the daily mandi data, which I think is getting reflected in the vegetable inflation number that we are seeing. But broadly, I think on the food side, things are very, very comfortable. If you look at inflation in cereals, pulses, there again, inflation momentum has been coming down. I think for the core inflation bit, I think that the number would be somewhere close to 4.1%, which is very similar to the number that we saw last month. I think there again, most categories continue to kind of see inflation very much in line with, seasonal trends, apart from, I think, just gold prices, where in the month of August we had seen some increase. So bottom line on the inflation data, I think, seems to be that, inflationary pressures are at current stage remaining very, very comfortable.
As you pointed out, Aditi, of course, given how Sakshi also put that into perspective, but what I want to understand from your vantage point over here is, what do you think are the factors that have really driven these kind of numbers that we're looking at?
Broadly, the trend in the last few months has been a very low momentum as far as the food inflation is concerned, especially when you put it in the seasonal perspective. So typically you see food prices becoming a lot more expensive over the summer and the rainy months, and broadly that momentum has been very slow for most categories this year. And in any case, we are sitting on a very substantial base effect because food inflation was very high at the same time last year, and then it started unwinding after that. So a big part of the low inflation readings that we've been seeing in the last few months is really coming because of the base effect, A, and because this year in general the food price inflation has been very low. Now we've had a good monsoon so far. Of course, last few weeks we've seen a little too much of rainfall, and it's time now for the rains to start withdrawing and for the season to end. There have been some instances of crop damage that have been reported. And I think now the question really is moving from a healthy increase in sowing to what kind of yield we will get overall on the kharif crop. So that's what everybody will be watching out for now. And if a timely withdrawal of the monsoon is going to allow for the harvest to happen on time or not. Broadly, reservoir levels are very, very full. That's something that again gives us a good amount of insurance in a sense for the Rabi crop to kick off in a timely manner. So all of these factors are very supportive for the food inflation momentum to remain low going forward as well. And we don't expect food inflation itself to become a big issue in the near term. It's mainly going to be the unwinding of the base effect that is optically going to lead to the inflation rates rising over the next few months, especially for food items. And then, of course, as we move across the next few weeks, the next thing that we're going to be looking out for is how the GST rate rationalization seeps through prices of different items and then pushes down the CPI over a period of time. So that's really the next big trigger that we're all going to be watching out for. What kind of an impact the GST rate rationalization really has on the CPI inflation readings going ahead. Our sense is that we might get a flattish number for September. Then we'll get another low in October, which is, October, November is where we expect to see the price rationalization coming through. And then once that's done, again, we'll get a sort of upslope in the inflation readings over the rest of the year. Previously, we thought that we will cross 4% in the fourth quarter of this fiscal year. Now, I think we may still have readings between 3.5% and 4% in the fourth quarter, and we'll probably end up crossing 4% only in April or later than that.
In fact, it's a very important point that you make, given the timing of this, right, with the GST rate rationalization that we've looked at, but of course, with that effect on 22nd. Let me take that to you, Sakshi, given how we're looking at that essentially, and could that also, while you of course speak about the timing of it and how you're essentially looking at this, could this also weigh on farm incomes and rural demand ahead of the festive season as well?
Well, look, from the demand perspective, of course, we are going to see some amount of postponement of demand, to Q3 from the second quarter, because households, both in rural and urban areas, would have, after the 15th August announcement, would have kind of decided to wait for the GST rate cuts to kind of come through before making certain, purchases. So we could see an impact of that on demand, but, things could really turn around, in my opinion, in Q3, where a lot of the pent-up demand effect plays out, and that coincides, of course, with the festive season. So, I'm estimating that you are going to get actually a bump up in demand, both from the rural as well as the urban side, from this, GST rate cuts that have been announced. Also, I think from an inflation perspective, again, I mean, look, even assuming that, there's a 50% pass through on average across product categories from companies, I do see that there's a downside risk to our inflation forecast for the year between 20 to 30 basis points. So we currently expect inflation to average at 2.8%. It could be even lower than this depending on the degree of pass-through that we see from companies across a range of products. So, both from the growth as well as inflation perspective, I think readings will incrementally look better as we move, into the second half of this year, particularly for the third quarter.
Okay, so some sort of positive relief that we are going to be looking at going forward. At least that's the word that you have given us. But I want to continue this conversation with both of you, Sakshi and Aditi. But I request you to stay with us because we're sipping a quick break. We're going to come back and discuss and decode this further for our, of course, viewers to understand that better. Stay with us on News Now. We're going to be right back to the course. All right, welcome back. You are watching News Now. In fact, the numbers have come in for the CPI data. You, of course, continue to see those important numbers flashing on your screens as well. Thank you very much, in fact, for staying with us. But let me continue the conversation with you, Aditi. What I also want to get a quick sense of as to how, the RBI, paused in August, citing global uncertainty. But does that now keep the door open for cuts in October? This is, of course, if growth falters.
Very interesting question. I mean, certainly we've had, since the August policy, more stress on the external side in terms of the tariffs and the penalties. and we are concerned that the exports, especially to the US, are going to dip down in the months ahead after some sort of front loading which we had seen in the early part of the year. Now, the GST rationalization that has come in after that, clearly that is something that we think is going to boost consumer sentiment, and it should lead to some amount of additional transactions as far as different varieties of consumer items and services are concerned. So that is broadly going to be positive on the growth front. And inflation is likely to come down after this. As Sakshi pointed out, it will depend on how much is transmitted by the companies. Now, our forecast for the full year inflation now for FY26 is 2.6%. But we've taken our growth forecast for FY26 back up to 6.5%. From 6%, we had reduced it after the tariff hit to 6%, and we've taken it back up to 6.5%. And also, if we look at the first quarter growth data, the momentum was clearly much stronger than what had been forecast both by the RBI and by the market. So at this point in time, I think looking at a rate cut in October still looks difficult. So if I look at the CPI trajectory, I think the next print is going to be flat, then we'll get a dip down, and then again we'll get an uptrend after that. So the outlook for the CPI inflation is still going to trend upward, although the entire trajectory has sort of shifted down. Now, unless we get a big shock on the growth front, and I don't think we will get any data to really suggest that before the October policy, I think an October rate cut is off the table. And even after that, possibly we're in for a long pause unless there is really a lot of stress which comes through on the growth front.
Okay, so in a sense, of course, talking about how this has been unpredictable for the global headwinds that we have seen. So you put that essentially into context quite perfectly there, given everybody is, of course, thinking about how that's going to be navigated. But I want to come to you, Sakshi, given how, global headwinds, of course, like we were talking about, they remain unpredictable. Should policy, in your opinion, be driven more by domestic inflation or by the external unfortunate tariff shocks that we continue to see?
I don't think there's a simple answer to your question. I think policy decisions are not just influenced by one or the other, right? I think it is a mix of what is happening to domestic indicators, of course, inflation, as well as domestic demand and growth, and taking into account at the same time what are the kind of global shocks or headwinds you are facing in terms of the tariff impact. Look at the headline level, of course, with the GST announcement and the kind of boost that it is expected to give to GDP growth, we have also revised up our GDP growth forecast for the year to 6.6. We were at 6.3 earlier. I do believe that there could be a further upside to this number if the festive season turns out to be much better than what we are expecting. But at the same time, I think we have to recognize that there's going to be a lot of unevenness in this growth, right, where a lot of the domestic consumption and businesses that have a higher exposure to domestic demand are going to do much better. But at the same time, we do get the sense that some of the, companies within, the export-oriented segments, which have a very large exposure to the US, for instance, the whole textile sector, there, we do expect that there's going to be a significant impact of tariffs, right? So from a monetary policy perspective, I think the central bank has already delivered a 100 basis point rate cut. They continue to provide a lot of, liquidity to the banking system to enable transmission. From here on, whether whether we are going to get another 25 basis point rate cut, etc., I think it's really a question of how growth performs in India rather than what happens to inflation. Because as we discussed, inflation outlook is going to remain very favorable. And from that perspective, I think the central bank has done enough. I think the ball is now in the government's court, where we would require a lot of fiscal support.
You make a very valid point there, but unfortunately I'd have to interject you because I'm afraid we're running short of time. But on that note, I want to thank the both of you for in fact joining us here on ET Now this evening and decoding essentially how you're looking at this. But of course, India's growth story continues and hoping we'll have another opportunity to be discussing that further as well. But for the moment, we leave it at that.
Up next, an